Lesson 6, the importance of news catalysts and other intraday fundamentals. Okay, so now if you take a look at this chart, we're going to notice that, well, the untrained eye may not be able to pick it up immediately, but we're going to notice that a few days on the chart are going to stand out. So this day on June 5th, this day on July 4th, this day on September 8th, and then this day on December 11th. Okay, now if we take a look at these days, you're going to see that the range of these days is wider than the range of all the other average days. And not only that, the volume on these days but also higher than the volume on the other regular days. Okay. Now the reason for this is because the stock had a news catalyst influencing the minds of buyers and sellers and that they exciting them. So either people were excited to buy, as you can see on these days that close green, or they were panicked into selling, as you can see on this red day, right? So these are the only types of days that we want to be looking to day trade stocks. Those days are the best days because the price action becomes more predictable, for want of a better word. Those days we can have an edge as retail traders who can get in and out easily because there's a lot of buyers and sellers, a lot of persons are trying to buy and sell, so easy to get in and out without something called slippage, which we'll touch on later. So the first thing that we do every day when we're preparing is we look to see what tickers have fresh news versus the ones that are just gapping for no reason. We want to stay away from those because those price actually tends to be random and unpredictable, but stocks with news tend to trade clean and be more predictable. Now, in addition to that, there are a few other variables that you're going to have to become aware of. So the first one is called the float. So remember we spoke about shares earlier, right? The shares outstanding or the shares issued are held by all investors in the company. These are called the shares outstanding, right? And these will be listed in what is called a shareholders directory, something that I had to do already in the past to create for my own company. So this will be a list of all the shareholders, their location and stuff like that, addresses and stuff like that, how many shares they own and what's the average price that they own the shares at and stuff like that. But this is different than the shares that are actually listed on the exchange, right? So some of the shares are tied up and not available for trading. Those that are available for trading on the exchange is called the float because they are out there floating around available for anyone to buy and sell. So most of the time you're going to see this be less than the shares outstanding because, like I said before, some of the shares are locked up and not available for trading. Okay, so that's the first thing, first important variable that we have to take note of every day when we're building our watch list. The second one is called a short float percentage. Now, in the stock markets, you're not only able to profit when something goes up, you can also profit when something goes down via a process called shorting. The shorting occurs where you borrow shares of a stock from a broker, right? And then you sell those shares on the open market. So you borrow first, you sell them on the open market, hoping that the price drops so that you can buy it back cheaper at a profit and then return them to the broker that you borrowed them from, right? So what the short float percentage tells you is out of the shares in the float, out of the 234 million, 390,000 shares available here in this example, 12.75% is out borrowed. The persons who are betting that the stock will go down, they is represented by 12.75% of the float. So these are the persons who are gonna feel pain, for want of a better word, if price keeps going higher. If a really good news event comes out and buyers are aggressively pushing the price up, then these people are gonna be feeling pain. Generally, if this percentage is over 10, that is very good for an idea that we are looking at to the upside, and over 20, 25, 30 is excellent, right? In fact, when stocks have over 20%, 25% short float, I generally am more hesitant to short them or bet for them to go down because these can be prone to explosive upside moves, violent upside moves, unpredictable upside moves, especially when the high short float percentage is combined with a low float, right? So low floats would be like 100 million, 70 million, 50 million. Those are what I would consider as low float. Yes, they're low floats. You will see stocks with like 5 million float, 10 million, but I avoid anything with less than than 50 million share float because these are very hard to trade, right? They're extremely volatile. They can get halted at any moment. They can get long-term halted. And, we don't want our capital tied up. We want to be in cash every night so that we can start with a clean slate every morning. So far, we looked at the float, the sharp float percentage. The next thing that we have to look at is the average true range. So, like I mentioned before, the average true range gives us an idea of how much price range the stock is likely to have on the day. So if you see $1 and the stock is going to open around 10 and it's going up, then chances are it's going to trade up to as high as 11. Or if it's going down, it's going to likely trade down to as low as $9. So this gives us an idea of how much, room that we have to potentially work with on the day. Okay. The fourth thing that we look at before the market opens is the average volume. Generally, we want to see higher average volumes because this means that the stock is going to be more liquid. It's going to be easier to get in and get out without slippage and so on. So the ATR and the average volume, the higher the better. The ATR, I do not look at stocks with an ATR of less than 1, and I do not look at stocks with an average volume less than 1 million. Our ideal zone is 10, 20 million, 30 million average daily volume, right? So in terms of the intraday fundamentals and news, there you have it. Now we look at how exactly do we find these in-play stocks? So the first thing is that we have to begin every trading day at 9 a.m. Eastern sharp. The market opens at 9:30 a.m. Eastern, so we need to give ourselves some time to run our pre-market scan and to investigate each ticker individually, look to see if they have any fresh news catalysts, and then if they do, we take a quick look at their float, their short float percentages, their ATR, and their average volume. So the first thing we do every morning, we sit down on our computer, we open this site called tradingview.com, and in order to have a screener, to run a screener, you need to create an account, which is not hard to do, or you can use your Gmail, and you create a scanner. I call mine pre-market scan, or you can call it gap scan, whatever you like, in-play stocks, whatever. And I have 6 simple criteria. The first one is that the stock should be up or down in the pre-market by at least 2%. In the next video, I will elaborate a bit more on what exactly is the pre-market. But for now, let's just take it at face value. So before the market opens and relative to the closing price in the last session, the stock is already up or down 2%, which shows that even before the market's official open, buyers and sellers are already engaged in the stock. Okay. The other thing that we need is a minimum of 100,000 shares traded. Okay. And then we need a float. Like I said, I do not touch stocks generally with a float less than 50 million. However, I have my parameters set to 20 million with a maximum of 700 million because stocks above 700 million, they're tricky to trade. They're kind of sluggish, so I generally stay away from them. That's just from experience, from my data. And like I said, I avoid stocks priced under 10. So, I'll trade anything 100, 200, 300, 1000, as long as the spread is not crazy. And again, we'll touch on the spread a bit later on. And like I said, the average true range must be greater than 1. The average volume must be greater than 1 million. And so when you run this scan, it produces a list of tickers that are moving in the pre-market. So what we do, we investigate, and this is how we investigate each ticker. We go to this site called finviz.com that you would have seen earlier in the video, and we punch in each ticker that appears on the scan individually, and then we scroll down. We look at the recent news section to see, is there anything that can cause the stock to have unusual violent price movement on the day? If no, we move on to the next ticker until eventually we find something that has news, and then we make a note of the float, the short float percentage, and so on and so forth. So this gives us a preliminary watch list. It gives us a list of stocks with potential day trading opportunities for the day. I mean, of course, we do not know how things are going to pan out, but these stocks are the most probable to making money day trading for that particular day. So again, as you notice, we make note of the catalyst, and I'll send you a copy of the spreadsheet, guys, if you're interested. So we make a note of the catalyst. Sometimes the stock Had a catalyst of Friday and it's still experiencing, high volatility and value in the next day, we call this a second day play. Otherwise, the catalysts are typically either sales related, earnings related, FDA news, so pharmaceutical stocks, or drum news. Could be product related, like a product recall, new product, breakthrough. Could be management related, new CEO or CEO stepping down. Could be fraud allegations. Could be that they secure a loan or equity financing. Could be a pre-earnings announcement. Could be an analyst upgrade or downgrade. It could be an economic stimulus. Could be just a sector play. A sector is just hot, like AI stocks were hot. Space exploration stocks were hot at one time. Quantum computing stocks were really hot earlier this year, and so on. It could be moving with the overall market, so sometimes the overall market gets really hot. Could be Fed earnings, Fed rate cuts, or rate increase, or what have you, Trump policy change, or what have you. It could be that they're going to acquire a company that's going to change the trajectory of the company's earnings and so forth. It could just be a purely technical setup. The stock is breaking out of a nice tech consolidation of flag, and it looks very likely to be in play on the day, and so on. So this should give you an idea of how we put together our preliminary watch list. In the next video, I will show you how we narrow down from this list of on this day 7 to around 2 to 3 that are very likely to give us our particular setup, which is called the trend continuation setup. So guys, see you in the next lesson.